Here's another late development, and this news keeps coming in as we're talking here.
That is our meme of the week. This week, I thought it would be interesting to do something new. And over the past two episodes, I've been talking about, I'm practicing, trying to learn more about unusual options activity and scanners and things like that. And I talked about scanners in one of our previous episodes, so check that out. But this week, I want to just give you guys just a summary of like what it is that I've learned so far from my journey in understanding unusual options activity. But as context, there's always people asking questions, especially beginners. They're saying, okay, what strategies do you use for options trading? Or how does options work? I've explained how options work, so check a previous episode. Now to answer the second question, what are strategies that you use? One of the strategies that I've been using has not been working recently, so I've been trying to learn new ones. One of them that I've heard a lot about is this thing called unusual options activity. And basically what that is pretty much paying attention to when people are buying or selling an option more so than their usual. So different platforms provide a metric or number that kind of measures, okay, what is the average volume or amount this underlying asset is being traded or not. So for stocks, that is the volume. For options, there's something a little bit distinct called open interest, and that pretty much tracks how many open contracts are there for this specific option. And basically, that's a way to this way you can cross-check that against the average and its current value, and using that as a metric. Okay, something else is going on. Someone knows something that they shouldn't know, maybe some insider trading and things like that. And that's a great strategy. But before I jump straight into the strategy itself, I want to give you guys a great format I think is really dope that we should implement ourselves for any form of trading. And this kind of applies to all forms of trading, but we're going to be specific to unusual options activity today. And typically the format is you formulate an investment objective. So, okay, are you looking to make this amount of money off this call? Are you betting that, okay, you want to invest or have some stake in rising oil prices or things like that? You got to decide, okay, what is it that you're really going for? What is the objective? And that could be anything from, it can be anything from saying, hey, I want to hedge this position, or I want to diversify my portfolio, or I want to focus heavily on tech stock or cannabis stock since that's going up. That's pretty much your objective. Then from there, you structure out the rest of your strategy. Specifically for options or unusual options activities, there's typically three investment objectives. And that is either to one, hedge a position, meaning if I have 100 shares of Microsoft and I believe there's a chance that it might go down in the near future, I'll buy a short-term option call or options put on Microsoft because I believe it's going to go down, and I don't want to let go of my shares, maybe possibly for dividend reasons or things like that, or not wanting to lose or miss out. What I'll do is I'll keep my 100 shares of Microsoft, but buy a put option that requires less capital but has higher return on it. And basically what that would do is allow me to offset the loss. Maybe it's a 5% loss on the stocks itself, and it'll probably make me more as it's going down than what my stocks is going down. And I guess keep the stocks, sell that put, and be able to just hedge off the loss. And then it looks like I didn't lose any money at all. If anything, I have more money to play around with. And a lot of people that do that are mainly institutions that cannot easily let go of a huge amount of shares. And basically they use that to kind of keep their results. Okay, we didn't take a huge loss this quarter. Another main objective is speculation. So this is for more so aggressive investors, people like myself who don't have huge amount of capital, but I'm looking to grow that as quick as possible. And basically the goal is to, if you see something happening, you notice it's like, okay, I believe very strongly that this is going to happen. Like maybe Microsoft is releasing the Xbox. So I think, okay, everyone's going to go crazy and buy a lot of shares of Microsoft, or that's going to increase their revenue. I would speculate that the Microsoft stock is going to go up, and then I'll buy an options call. So that's another way of having an investment objective. And lastly, premium selling. This is something that I'm just learning about, and I did not know much about it, but it kind of makes sense when you dive deeper into it. And basically, this basically says that, hey, as you're holding a stock, so for those people that are long-term investors, they have maybe 100 shares of a stock like T-Mobile, and for some reason, it doesn't move around a lot. What you can do to build income on your shares in those stocks is you can write a contract and sell it to someone else saying, hey, if this happens, you get this, you can buy this shares, but you know for on your side that nothing's gonna happen. So basically just getting income from selling and taking the premium on that option that you wrote and sold to someone else while your stock is doing nothing. So basically you're getting money from your stock doing nothing. And those are just some of the objectives. Then from there, depending on what your objective is, you kind of set a risk reward payoff. So basically saying, okay, am I willing to spend this much for this amount of gain? And with options, if you buy an uncovered option, a lot of the time, those are infinite reward, where the risk is pretty much just the amount you put in. So basically, as good risk management, you don't want to put your whole account in. You just want to put something that's, okay, I don't mind losing this if this goes wrong, but I'm confident in the fact that this is something that will most likely go right. So I'm going to put my investment in, which is a premium. For me, I try to go for nothing more than 15% of my account. And I size it based on how sure I am on those calls. The next is actually going to do the due diligence. Checking, okay, what events are coming up. And events could be, do your due diligence by checking what the events coming up regarding that stock or asset is, as well as checking the volatility. But first, what are some of the events that could happen? It could be anything from earnings reports, dividend announcements, product launches. It could be, and those are the ones that you can expect and are scheduled on calendars and you get the announcements early. Or it could be something that a lot of people are not aware of. This is more so called unexpected catalysts, stuff like a CEO making an announcement, just like with Pfizer this week. They announced the results of their vaccine performance on studies and things like that. And that was unexpected, but made a lot of huge effects on the market this week. And we'll talk more about that. It could be something such as institutions giving an analyst upgrade or downgrade. It could also be an investor taking a major investor taking a position on a stock or getting out of a position, or a black swan event like COVID, stuff that you cannot expect. And these really move the stock. And these are the things that you kind of should factor in while coming up with your strategy. And finally, those events will basically determine the volatility or imply volatility of these stocks. So what you want to do with, especially with unusual options activity, you want to check the volatility. Okay, what is the percentage implied in volatility from different moves? And you normally show that on different platforms as, okay, this is expected because of the current market conditions, and it changes every day. And you also want to cross-check that volatility as well with the change in volume of the stock or the option. So you want to see, okay, if the average daily volume for this stock is really 1 million, and all of a sudden it's trading 5 times that, 11 times that, 11 million, obviously something is going on. Someone is not aware. Someone's aware of something that is going on that a lot of people don't know. And typically those will be institutions. So you want to check and see, okay, what is that is. But a second thing also is of checking the volatility is to know, okay, am I coming in too early or too late? Typically, you want to get in when the volatility is low and ride it as the volatility goes high, because as volatility increases, the price of the option increases as well. And that's how you make your money off options. You want to buy in a lower volatility and sell at a higher volatility. And typically, if the volatility is above a certain threshold, typically you don't want to get in, because at that point, the price is extremely high. There's too much going on. And if the volatility falls for some reason, you're losing money no matter what the stock does. And that's called the volatility crush, the IB crush that a lot of people talk about, and what a lot of options traders lose a lot of money on because of. But that's just a high-level overview of that. And finally, just establish options perimeters. And that should be easy once you've done all these other 5 steps. So, okay, if you think the stock is going to go up to this amount based off this news, obviously you want to buy one that's either in the money or out the money of around that price, and not go way too far off from that point. You want to set the expiration date. So if the earnings is next week or 2 weeks from now, you got to decide, okay, for yourself, based off your strategy, are you selling before the earnings? So you know, okay, the expiration date needs to be before the earnings, or you think it's going to be a post-delayed reaction? Also, setting your expiration date after the fact. And obviously the last one being pricing. Obviously you want to go for the cheapest price and not the highest price. And you do what works to your account. But that's pretty much a just general overview of any trading strategy, but more so tailored to unusual options activity. And I will talk about a couple more points. But before I jump into that, any questions regarding that so far?
Yeah, I have a question.
Yeah.
On apps, is there any way you could tell when the volatility goes up and down, or you have to check on your own? Is there any signals or
Basically
anything?
tracking it, yeah. You got to manually track it, or going back to last week's episode, talking about scanners and lists. When you're looking at, well, that wasn't last week's episode. You can use scanners that track. Okay, did the volatility go up on this stock specifically? So it tracks it for you. But basically, yeah, you have to check those. There's no way to say, okay, the volatility went up 10% today. You
have to create a scanner for it. It's super important. But when every time you set up an option on Robinhood, it gives you a snapshot of the current volatility.
Yeah.
So you can use that snapshot, but volatility literally can go from 0 to 100 in a millisecond.
Yep.
But it will give you that snapshot for a brief second. So if you use an average of the snapshot of opening and close, you can then use that as your general average. But ultimately, a scanner is what you're going to need to have a definitive by the minute type answer.
All right. Yeah, sounds good.
Yep. Just a couple other points. I'm still wrapping my head around unusual options activity and things like that. But the biggest thing that I've seen is to really validate and check this current day volume across the open interest. There's a difference between the volume and the open interest. The open interest is the amount of open contracts, while the volume is the amount that have been traded overall. So it's a little bit different, but you can use that to compare those. I'm still getting the hang of it and kind of pay attention to that. So that's something I am still practicing. Another thing is determining the magnitude of the move based off of the open interest calls and contracts. So basically what they're saying is, a good example is if you see for some reason there's 5 times more open interest than normal on a strike call for $210 of a stock, but the price is at 180, that you can deduct from that okay, maybe someone is betting by this expiration date of that contract that the stock is going to hit up $210, and that is what, $30 over 180. That's about 1/6, roughly 15% move. That's basically what they're saying. Hey, there's going to be a 15% move on this stock by this date. And that's probably an institution backing it probably from insider information. So you want to keep track of those. So that's basically saying, okay, by this date, this stock is going 210. What are the plays that I can make to do that? You can probably mimic that or maybe do something different based off that. But basically, you're taking this information, although not guaranteed, and determining what is the range that this stock is going to do. And that helps you reduce and, organize your strategy better. That is something I did not know about prior to this week, and I might even start practicing that myself and actually thinking, okay, if this person is putting this much weight into this, that means that is, how does that affect where I think this stock's going? I can know when to enter or exit based off that. Also, discovering the direction of the trade. I also am figuring out how to do this because basically it can apply 2 things, because either the person might be hedging or they might be speculating. So using different hints or indicators to kind of track, okay, this means this is going to be this bullish or move on this, or is it going to be bearish? You can use the options activity to determine the direction of where the price is going to go and where you should kind of be positioning yourself on that trade. There are ways to track this using the options chain, which is basically where you go to see the different strike prices, expiration dates, and things like that. So I am getting hang of that. But basically one of the things that I've heard was that when you're looking at the options activity or the options chain, you can tell when it's being bullish or bearish based off how spread out the unusual open interest numbers are. So if it's on one specific thing, I believe that means that is bullish and it's been a bullish call on that. But if it's spread out, that means they're trying to get out of their position and might be shifting that into different things. But I will confirm that the more as I'm learning this concept or strategy as I go. Again, analyzing the options chain for opportunities. One thing that I was probably incorporating into my schedule is just looking through different stocks and seeing, okay, are there any unusual activity going on here, until I find a way for automated way for it to kind of alert me of these options activity. And yeah, basically using those 2 things are the biggest things. But a lot of things that happen is you can tell based off the number of open interest, whether it's uncovered position or if it's a strata, which is betting on the volatility. That is a different strategy that you can use to kind of make money instead of not directly from the price itself, but from the increasing volatility of these assets. But as we're learning that, we'll kind of use that as different ways. to kind of make money off these option plays. And I did see a good example, if that's something y'all interested in going through. Basically, it kind of walks through how you frame a strategy. So for someone like us, more myself, where I'm an aggressive trader, and I believe the prospects on a company like Bank of America is bullish, and I have $1,000 I want to use for options trading out of everything I go on. My objective is to buy speculative calls on Bank of America, which is trading at $30. This is speculative. This is just an example. And I think, okay, I want to make money off this. I think Bank of America is going to go up. That's my objective. Now it's for me to determine what my risk or reward is. If I don't mind losing $1,000, if I'm only looking to lose 500 out of that 1,000, that kind of changes what kind of option I'm going to buy on this stock itself. And it helps me decide, okay, am I looking to lose this amount? How much am I going to win off this? But the next step would be to check the implied volatility. The implied volatility for this call might be something where around $17. If the stock is at $30, the next price above that would be $31 or $32. I need to look at those implied volatility numbers on that for 1 month calls as well as 4 month calls, because you want to see, okay, where is the movement going to happen between? And lastly, checking the market volatility as well. You just want to make sure that you're in a good space where the market is in a condition that will support your strategy or your objective. And lastly, checking as well the events that are going on. So here they checked and said, hey, the company does not have any earnings since they just had theirs, so there's not much from there. And just think of what are the other events that can happen. Is there another company that's doing earnings related to this stock? Is there a competitor releasing or IPOing around this time? Or try to think of all the unexpected things, such as COVID. What happens if a vaccine just pops up? What if there's no vaccine and things like that? You got to factor those in to when you're making a decision on specific plays. But you can only do so much since a lot of those are unexpected, but the most expected ones are the earnings, product launches, and things like that, things that are already announced. And lastly, what strategy works best for these conditions? Once you've looked at the conditions, you know what your objective is. Is it the smartest thing for me to buy an options call or options put? If I'm going with the call, does it make sense for me to do an out the money call or in the money call? For this, I'm confident that this is going to go up. So I'll most likely go with out the money call for multiple reasons. One, because they're cheaper. They give me more time to kind of get out the trade if it doesn't go according to plan. And I can use that to kind of increase my gains off what I'm believing confidently in. If not, I can use something different and come up with my own pros and cons. Then you kind of know what strategy to use. Lastly, just choosing a specific parameter. So what specific strike price, what specific expiration date, and what specific price am I comfortable getting in on. And basically using that as a way to kind of make that. And that's basically how you come up with an options trade. In this case, you don't see much about unusual options activity. But if I do notice something different with the volatility or the open interest and volume, that will be a good indicator on, okay, changing what the strategy is or changing what my parameters would be for that trade. And yeah, that is the lesson of the week, unless someone else has any questions regarding this. Dope.
I think that's good.
Dope. And this is something that I am working on and working to get better on, but I'm going to be using this framework for a lot of the calls that I'll be using for things I do. And yeah, just as a heads up, for the next week, we will go in over the chapter 3 of the book we've been reading for the past 2 episodes called Calculated Risk by Kevin's Trades. Again, if you are interested in getting this book, we do have a discount code, Trade Tribe. You get 15% off the already 50% discount on it. This is closing soon, so make sure to go check that out. It's $100 retail, but it's selling at $50, and you get another percentage off if you use our discount code. So definitely check that out. $64 off knowledge of something that will make you millions or thousands in the future. And use that as a way to get into the options trading, using technical analysis and things like that.
If you're joining this group, and just to say this, if you're joining this group and you haven't taken the time to read a book, like how hungry are you for this? Like, yeah. You can come here and probably score big on one of our call outs or something like our predictions, but how great is it to already have that knowledge up here so you can do it yourself? it's better to be the person making the call out than being receiving the call out. That's all I'm saying.
Exactly. That's a great point. We got to keep growing and not rely on people that you have given you gains in the past. You want to be a self-reliant trader and investor. But yeah, check out that discount opportunity and be ready for the next week. We'll go to chapter 3, the last chapter, and possibly moving on to it. And if you have any suggestions or books you're interested in, courses, definitely recommend that to us and we will give it a read.